Did you know that over 90% of actively managed funds fail to beat their own benchmark over a 15-year period? That means most people paying high fees for expert stock pickers are actually losing money compared to just owning the market. Are you one of them? With market volatility hitting new highs, sticking to an old, expensive strategy is a surefire way to see your portfolio shrink. But there's good news. In this video, I'm going to give you a simple, powerful plan to take control using 3 specific types of ETFs that can form the core of a resilient portfolio. My name is Lucas. I am one of the co-writers for Financial Stories. And after a decade helping hundreds of clients navigate these markets, I've seen what works and what doesn't. We're going to break this down into 3 simple moves. First, we'll build your foundation. Second, we'll add a growth engine, and this is the one that saves most people money on fees. And third, we'll add a defensive layer. Stick around because that third one is a secret weapon that many investors overlook. And I'll reveal exactly why it's so crucial for today's economy later on. So let's dive in. The problem many investors face is complexity. They're sold a dozen different funds, each with confusing strategies and worse, hidden fees. They try to pick individual stocks, get burned, then retreat to cash, missing out on all the growth. The friction comes from thinking you need to be a Wall Street genius to succeed. That's where my big insight came. The simplest plan is often the most effective. The solution, build your portfolio around a few core low-cost ETFs. Let's start with move number 1, the foundation. This is your broad market index ETF. Think of funds like V, which tracks the S&P 500, or VTI, which covers the entire US stock market. Why start here? Because you're instantly diversified across hundreds or even thousands of the biggest companies. Let me show you the math. The average actively managed fund charges around 0.8% in fees per year. VOO, on the other hand, has an expense ratio of just 0.03% on a $100,000 investment. That's a difference of $770 in fees every single year. Over 30 years, assuming a 7% average return, that fee difference alone could cost you over $75,000 in lost gains. That's the power of low costs. So you're getting broad market exposure for a fraction of the price. That's your core. Done. Now, let's move on to the second type of ETF, the one that really saves you money while adding a growth kick. A sector-specific ETF. A common myth is that you need to buy individual tech stocks like Apple or Nvidia to get high growth. The truth is, you can get concentrated exposure to the entire technology sector through an ETF like QQQ or VGT. Here's a quick case study. A client of mine, let's call her Jane, was trying to pick winning tech stocks. She bought a few that did well, but one bad pick wiped out all her gains. We shifted her strategy. Instead of individual stocks, we allocated a part of her portfolio to a technology sector ETF over the next 5 years. She captured the explosive growth of the entire sector without the stress of picking individual winners or losers. She got the upside without the single stock risk. If you're thinking, but won't a sector ETF be more volatile? Yes, it can be. That's why it's not your entire portfolio. It's a strategic slice meant to be your growth engine. It complements the stability of your broad market fund. This is how you build a balanced, yet powerful portfolio without paying a stock picker. Before we get to our final ETF type, the one that acts as a defensive shield, I want to hear from you. What's the biggest challenge you face with investing right now? Is it picking the right funds, dealing with fees, or just knowing where to start? Drop your biggest challenge in the comments below. I read everyone, and your feedback helps me create better content for you. Okay, 2 down, 1 to go. And this last one is the secret sauce that separates savvy investors from the rest, especially in uncertain economic times. This is the mistake that causes most portfolios to lag during downturns. So what is it? It's a quality dividend growth ETF. Let's break that down. These ETFs like SCHD or DGRO don't just chase high yields. They focus on companies with strong balance sheets, consistent earnings, and a long history of increasing their dividends year after year. Here's why this is so critical. Remember our hook at the beginning? Over 90% of active funds fail to beat the market. A big reason is how they perform during downturns. When markets get shaky, high-flying growth stocks can plummet. But strong dividend-paying companies tend to be more resilient. They're often established businesses providing essential goods and services. People still buy toothpaste and use electricity in a recession. These ETFs give you two things: a steady stream of income from dividends, which you can reinvest to buy more shares, and a defensive cushion because these quality stocks tend to fall less than the overall market during corrections. It's your portfolio's shock absorber. This is how you protect your downside without sacrificing long-term growth. So the simple plan is this: start with a low-cost, broad market ETF as your foundation, add a sector ETF for a targeted growth engine, and finally, layer in a quality dividend growth ETF for stability and income. This three-fund approach gives you diversification, growth potential, and defense. Let us recap the big takeaway you can share with a friend. A simple portfolio of a broad market, a sector, and a dividend ETF can outperform most expensive, complex strategies. Now, you have a powerful framework, but knowing what is only half the battle. The how is just as important, specifically how to allocate your money between these three funds based on your age and risk tolerance. To help with that, I've created a complete guide in my 7-minute Recession Playbook playlist. Click here to watch the next video, where I break down the exact percentages you can use to build your own personalized portfolio. And of course, all this is for educational purposes and not financial advice. Always do your own research. If you got value from this breakdown, hit that subscribe button, because in my next video, we're diving into the biggest tax traps to avoid with your investments. Thanks for watching, and I'll see you in the next one.